Well, good afternoon, and thank you for coming. We had 70 RSVPs, and we know 10 or 15 people are caught in traffic, but we really need to carry on, and it's really important that Gary is here, and Gary has consented to allow us to video the discussion, and I'm very happy that those of you who received the invitation, made it through the nice weather, made it through traffic, or walked across campus, right, Jerry? Happy you're here, and Gary is, in my view, one of the most influential speakers that we certainly have had from UCLA Extension. For those of you who don't know me, that's less important, but I'm Roger Torneden, and I head the Business Management and Legal Programs Department of UCLA Extension. Gary consented to spend a little bit of time with us today on essentially a free lecture discussion, which UCLA is pretty famous for it, but UCLA Extension is getting our feet wet in this area. In fact, I think Gary may be the first high-level person who we've had in a few years for a presentation. I thank you for being here. Gary, in terms of background, is a graduate of Georgetown University, London School of Economics, and Princeton. He was the Chief Financial Officer of the World Bank and the Chief Financial Officer of Capital One, and right now he is on a project to craft the job description, which I understand he's already done, and to search for a chief risk officer for the Department of Treasury to manage the $3 trillion of insurance guarantees, loan guarantees, and other obligations that are potential future liabilities for the Department of Treasury. And this is actually in addition to or separate from the Federal Reserve and their $3 trillion of balance sheet additions in the past 5 or so years. But without further discussion on my part, I'd like to introduce Gary Perlin. Gary?
Thank you, Roger, for the introduction, and to you and your colleagues at UCLA Extension for inviting me to join you today. I'd like to thank those of you in the audience for joining me, especially during this holiday week. And in return, I will be sure to leave plenty of time to take your questions at the end of my remarks to make sure that which you'd like to talk about, we find time to do so. We all know the expression, home is where the heart is. And although I've lived and worked in and around Washington, D.C. for the last 40 years, our precious 2-year-old grandson and his parents, of course, have the good sense to live just a few minutes' walk from here in Westwood Hills. So you'll understand when I say with all sincerity that it's good to be home. Still, the home in which I spent most of my adult life is that other so-called Hollywood, the one on the Potomac. It's a richly deserved nickname, given the seemingly never-ending drama and comedy produced in the nation's capital. I'd say it was directed as well as produced there, but it's not always clear that someone's actually in charge on that particular set. But my topic today is not about Washington, D.C. as a filmmaking capital, not even for the diehard fans of House of Cards or Veep. I'm actually here to talk about Washington as the world's financial capital. Why do I call Washington the world's financial capital? Well, as we've been reminded these last few years, Washington is not only where the buck stops, it's also where it starts. You may not think of Washington as a city which actually makes things, but what about fiscal and monetary policy? And as any privately or publicly owned financial institution or exchange in this country will remind you, DC is the place where the rules are made, which allow them to operate, and which can determine who wins and who loses. Now, sure, you might be thinking, the legal and regulatory framework for all industries is set in Washington. But aren't the really consequential financial institutions themselves housed in New York or Hong Kong or London? That would be a reasonable question. But consider the following. More than 3/4 of America's home mortgages are financed in and around the Capital Beltway by Uncle Sam's daughter, Ginnie Mae, or close cousins, Fannie Mae and Freddie Mac. Global financial markets always hold their breath, waiting to hear what the chair of the Federal Reserve has to say as the Federal Open Market Committee finishes its regular policy meetings at Constitution Avenue and 20th Street. Meanwhile, a few blocks away from the headquarters of our central bank, over on Pennsylvania and 19th Street, you'll find the central bank to every other central bank. It's called the International Monetary Fund. Across the street from the IMF is the World Bank, the one truly global development finance institution. Now, granted, only one of America's top 10 banks is headquartered inside the Capital Beltway. As it happens, that bank is Capital One over in McLean, Virginia, where, as Roger told you, I had the privilege of serving as CFO for 10 years. But if you go to open a bank account here in California, or in any of the 8,000 or so banks in this country, anywhere from Maine to Hawaii or Florida to Alaska, what do you look for? It's a sign on the door that says, your deposit is guaranteed up to $250,000 by the Federal Deposit Insurance Corporation. Yes, the FDIC, just a few short stops on the metro from downtown Washington to Arlington, Virginia. I could go on, but I'm sure you get my point, which for me is anything but academic. After all, I've spent decades working as a financial institution executive in Washington. And it just so happens that my time there has been about equally divided among careers at 3 of the institutions I mentioned in reverse order: Capital One, the World Bank, and Fannie Mae. So, if you allow me, I'd like to share the perspectives of one recently retired executive based on a financial career in what one could call Capital City, with all its connotations. I do so not as a matter of personal reminiscence, but as a means of putting into broader perspective where financial markets and institutions are today, the forces that have shaped them, and what all this might tell us about what lies ahead. I'll ask for your forgiveness here in advance if it means that I spend a bit more time looking backwards than forwards, but I want to be sure that you know where I'm coming from. You know, this is probably also a good time to acknowledge that the title of this lecture, What 4 Decades and 3 Crises Say About the Future of Finance, first announced by UCLA Extension in March, seems eerily similar to the cover story in last week's edition of The Economist. Anyone see that? Well, you can imagine my surprise when I saw that article entitled, quote, A History of Finance in 5 Crises and How the Next One Could Be Prevented, which I read on the flight out here to LA. Well, after an anxious read, I am relieved to report that the crises to which The Economist refers range from 1792 to 1929, while the ones I will speak to start in the 1980s and end with the financial meltdown of 2008. But as a lifelong reader and somebody with deep respect for The Economist, I am glad to say that their observations are not inconsistent with my own. In short, they conclude that the seeds of each financial crisis are typically sown in the way which governments and markets respond to the previous one. Whew. Now I can get on by telling you my story. In order to do so, I need to take you back well before some of the students in this room were born. I begin with the world of global finance in the mid-1970s, a period which witnessed an explosion in market volatility. What was left of the gold standard had been abandoned. Oil price inflation, budget and trade deficits, and deregulation together conspired to upset the sleepy, fragmented financial markets I was entering as I left grad school. In order to tame what was then raging inflation, the Fed adopted a monetary policy that prioritized achieving steady growth in the money supply. As a consequence, interest rates exhibited unprecedented volatility. Short-term interest rates rose to nearly 20%, and mortgage rates were as high as 16%. Believe me, I had such a mortgage, and I felt pretty lucky to have it. Worldwide interest rate swings, combined with volatile exchange rate fluctuations, the result of abandoning the last of the post-war Bretton Woods norms. And it was just about then that I began trading commodities at what was then a small private firm on Wall Street, using futures to hedge positions in precious metals, as they had been used for years to manage price risk in coffee, cocoa, soybeans, and more. Silver and gold prices suddenly rose by a factor of more than 10 and 3 respectively, and fell an equivalent amount in a matter of months. Notwithstanding that epic roller coaster ride, and I do like roller coasters, hedging with futures allowed our small firm to manage its risks and, in fact, to prosper. Up until then, things had been relatively quiet in the nascent market for interest rate futures, which were first listed on Chicago exchanges back in the mid-70s. Suddenly, the gyrations in interest rates caused the leading government bond houses to start asking firms like ours to serve as their Treasury bond futures brokers. In those days, one only traded futures through commodity firms. That is, until investment banks discovered that financial instruments could be traded just like other commodities and started buying firms like the one I worked for. In case you haven't noticed, Wall Street typically responds pretty quickly to emerging trends, whether they're sustainable or not. What I couldn't understand was the reluctance to embrace new hedging vehicles by the larger financial institutions away from Wall Street, those whose balance sheets weren't structured to endure unprecedented rate spikes. So I decided to join one of those institutions at the beginning of the 1980s when I returned to Washington and signed on at Fannie Mae. I discovered then just how challenging it was to introduce risk management instruments into firms that hadn't appreciated or measured the risks they were taking, let alone that fundamental market change was occurring. Fortunately, at Fannie Mae, we caught the trend at a relatively early stage, even though the volatile conditions and necessary hedge vehicles which were spawned by them had been around for a while. That's about the same time those vehicles acquired what seemed, at least at the time, a more respectable name: derivatives, or contracts which derived their price in reference to others. Now, the same volatility which created the derivatives markets also unleashed another game-changing trend which unfolded quickly through the 1980s. The supplanting of local and regional banks, savings and loans, and similar institutions by national capital markets. As leveraged financial actors, tradition-bound bankers were accustomed to using their capital to underwrite the credit risk of familiar local borrowers and to support the minimal market risk they thought they faced, at least when deposit rates were regulated and yield curves were consistently positively sloped. As those market risk assumptions were proven radically wrong in what seemed like an instant, rate movements quickly overwhelmed the capital supporting banks' balance sheets, and especially those of America's venerable old thrift institutions, the savings and loans. And if that doesn't make sense to you, since we are right down the road from Hollywood, just think It's a Wonderful Life, in which the Bailey Building and Loan funded long-term mortgages with short-term deposits, and then imagine the effect of rapidly rising interest rates on those deposits. Now, at the same time that was going on, institutional investors with more lightly regulated products were attracting the growing wealth of baby boomers, such as myself and some of the other folks in my age group in the room, who were beginning at that point to accumulate savings for our children's education and for our retirement. Large mutual funds in particular were far better positioned in the 1980s to take on market risk than banks or thrifts. They were interested in long-term returns for investors like us and weren't so concerned about consistent interest rate spreads because they weren't carrying positions on their own balance sheet. So they were able to hold on to positions even when the market moved against them. Those funds had a longer-term time horizon with their investments, consistent with the time horizon of the investor looking to put their kids in college someday or retirement. And those investment funds measured their success not by their current period profit margins, like banks did, but by outperforming their peers when it came to investment returns. They used up less risk capital than banks, although they invested significantly in human and informational capital. In order to be successful, however, they needed one more thing. What they needed were tradable investments that they could invest in. Such investments had to have limited credit risk, reasonably standard structures, and deep liquidity. The answer was, in a word, securitization. Indeed, it's hard to imagine the ascendance of the capital markets in the 1980s without securitization, and hard to imagine securitization without the jump start provided by the government-owned or government-sponsored mortgage agencies, Ginnie Mae, Fannie Mae, and Freddie Mac. Ironically, Fannie Mae had been created in response to an earlier wrenching paradigm shift, one that accompanied the Great Depression. Please note, this is the kind of pattern reflected in the essay in last week's edition of The Economist. Fannie Mae had not developed as expected during the Depression when it was created, when it was a wholly government-owned entity, nor had the newly authorized local mortgage associations intended to finance local mortgage bankers. But the existence of a by then privately owned Fannie Mae and its siblings in the early 1980s, along with the ability to influence broadly followed mortgage underwriting standards and the presumption of government backing, together proved critical to the housing market. The housing agencies made it possible to fund hundreds of billions of dollars worth of mortgage loans in the capital markets, just as many savings and loans were closing their doors. Some because their deposits fled to money market and other investment funds, and some, perhaps like Bailey, because their mortgage portfolios were too locally concentrated in boom and bust real estate markets. The mortgage-backed security was quickly accepted as a market standard, backed to some extent by the government, but also, just as importantly, by the large volume of relatively homogeneous assets secured by homes, which were largely all rising in value. It wasn't long before the technology of securitization was adapted to other kinds of consumer loans. First auto loans, then credit card receivables, and more. Financial engineers matched the risk appetite of investors with the cash flows and risks of specific pools of assets whose credit was either government-backed or supported by security structures which assigned first risk of loss to a few holders of subordinated interests, those who were aiming for really high returns. The U.S. capital markets provided incredibly efficient funding for what then became an explosion of consumer credit. Local banks suddenly found themselves competing with specialty finance companies who funded themselves in the capital markets, firms like the one that became known as Capital One. In 1985, there were some $20 billion of securitizations issued pretty much all from the mortgage agencies. And believe me, at that time, it seemed like a pretty big number. However, just 20 years later, in 2005, some $1.5 trillion of asset-backed securities were issued, only half by the government-sponsored mortgage agencies, and the other half, $750 billion worth, by what were considered private issuers of auto, credit card, student, and non-government-backed mortgage loans. We now know, having lived through the financial crisis that began in 2007 and 2008, that this trend could not continue forever, and in fact, it helped to sow the seeds of that particular crisis. But before we get to that crisis, let's stick to the chronology and go back for a look at one other market development I happened to witness firsthand in the 90s, sitting in Washington, and that is the growth of so-called emerging markets. It's there I really saw the precursor of what was to become this country's own once-in-3-generations financial crisis, the one from which we are still recovering today. As the 80s ended, U.S. equity markets had suffered a setback. Maybe you remember the big crash of 1987 that was forgotten very quickly, but in those days it seemed like a pretty big deal. And partly in response to that, U.S. interest rates were brought way down. The growing pools of institutionally managed assets I described earlier began to flow abroad in search of portfolio diversification and higher returns. New technologies allowed investors and intermediaries to complete transactions quickly and securely. Cross-border regulations were lifting, and in many cases never really existed because markets were historically supervised on a national rather than a global basis. Communications and information engineers made it possible to talk, trade, and settle transactions across borders and multiple time zones. Meanwhile, a new class of financial engineers developed security structures and derivatives that enabled investors to build global exposures without physically ever leaving their home market. By the early 1990s, capital market investors who had mastered the art of seeking out returns and diversification wherever they could would be quick to recognize the opportunities in the newly liberalized markets, and at that point in time, faster growing markets, in the economies of Latin America, East and Southeast Asia, and Central and Eastern Europe. Emerging market investments by managers of bond and stock portfolios grew dramatically, with total private capital flows surging from under $50 billion in the early 90s to $300 billion by 1997, although most of these were highly concentrated among a half dozen or so developing countries. As in other markets, investors welcomed new tradable asset classes with presumed diversification benefits and higher risk profiles which promised higher long-term returns. This capital journey overseas was not a one-way ticket to success, however. Liquidity crises, first in Mexico, then East Asia, Russia, Turkey, and back in Latin America, shook investor faith and caused flows to turn negative by the end of the 90s. Why were positive capital flows to emerging markets unsustainable? It was a question I had to ask myself repeatedly, especially when I served as CFO of the World Bank in the late 90s. It was then that our own largest borrowers, the darlings of the first wave of emerging market investments, saw their credit ratings plummet, and these countries returned to the World Bank and other international lenders seeking loans in record volumes. What we recognized was that the earlier capital inflows had been very large into those countries in relation to the size and institutional capacity of the markets into which they were moving, and then tried to exit all at once. Even more dangerously, the flows often had little information content, since investors were often blindly following each other and not sufficiently concerned with how effectively the funds were being used. Ironically, some emerging market investors in the 90s seemed to adopt a kind of too big to fail paradigm, something which we all learned about a lot later, especially when it came to sovereign borrowers. Just as one of the largest sovereign borrowers, Argentina, was becoming a case of too big not to fail. Its public debt in the form of internationally traded US dollar-denominated bonds rose above $100 billion. And Argentina came to represent nearly 1/4 of the emerging market bond index, against which investment managers were typically benchmarked. Rather than requiring higher risk premiums from an increasingly leveraged borrower like Argentina, investors tied to the index felt obliged to buy Argentine paper regardless of the going price, and somehow felt comforted by the country's constitutional link to the US dollars. It was a classic case of risk premiums going down just as risk itself was massively rising. What was happening, in short, was that the borrower and the market itself were becoming too big not to fail. How did this happen? Well, I am not going to offer you an analysis of what occurred in Argentina, although I was there, and I fear if you went back there today, you would see a lot of it going on all over again. So let me simply say what happened is there was a huge growth in public debt, often at the regional and bank level, and therefore off the budget, which added unsustainable pressure to the country's unbalanced fiscal accounts. These accounts had already been undermined by years of recession, caused by, among other things, rigidities introduced by the currency regime and otherwise embedded in the country's dysfunctional political economy. At some point, new loans in and of themselves could no longer solve the problem. Indeed, they would become the problem, an unsustainable debt burden. The result was the largest sovereign default in history, at least until then. Over $100 billion in defaulted Argentine sovereign debt took over 3 years to be resolved, with several cases still pending today, more than a decade later. Of course, we face the prospect of even more spectacular sovereign defaults in the recent series of Euro crises, which reminds us of the importance of learning lessons and the magnified risks when we assume that this time it's different or it can't happen here. Have we learned that lesson? One can only wonder after observing recent market developments. In fact, in one 24-hour period last week, last Thursday and Friday, the government of Greece, where debt ratios remain unsustainable and the economy has been in recession for 4 years, sold a government bond that was spectacularly well received and in fact oversubscribed. While within the same 24-hour period, an auction of bonds by the government of China, which has a much lower debt ratio and an economy that is still growing at 7% a year, had an auction of their debt failed due to the existence of too low a ceiling on yields. Have we learned our lessons? I'm not sure. In any event, let's move from that crisis to the one that our economy is still recovering from, the seeds of which, like always, were sown in the response to the previous crises and the advance of financial and informational technologies that I talked about earlier. In retrospect, it's pretty easy to see how derivatives in the 1970s, securitization in the 1980s, and emerging market-type trading patterns in the 90s, all seemingly virtuous, pro-growth, and risk management enhancing developments set us up for the fall of 2008, the likes of which most of us have never seen. So let's rewind for a moment to the early years of this century, about a dozen years ago. Asset prices had moderated, and U.S. interest rates were pushed ever lower following the dot-com-led equity market corrections, sovereign credit defaults like Argentina, and the Fed's easing of monetary policy in the wake of 9/11. Globalization supported growth and helped reduce inflationary pressures, which allowed the Fed to maintain an extended period of easy monetary policy. Markets responded to this combination of factors in a way that by then should have seemed familiar. Somehow we never learn. Investors sought out higher yields, which, at least at first, offered seemingly appropriate risk premia, including on assets like subprime mortgages. Early gains suggested risk-adjusted returns were high, which led to increasing demand. The demand, in turn, decreased the risk premium for existing and inevitably new asset classes. And as we've seen through the previous decades, capital markets magnified the trends by connecting pools of increasing credit demand with supplies of capital seemingly well-structured, to the extent anybody fully understood, to absorb the growing risks inherent in diversified portfolios of tradable assets or specialized and concentrated portfolios of privately held assets. It's not surprising, at least in retrospect, that this storm ultimately intensified most around collateralized debt, especially mortgages. After all, secured loans to borrowers who acquired property early in the cycle performed better than expected because the underlying assets quickly appreciated in value. Extrapolating from this experience, markets offered more credit at lower spreads, assuming that collateral values would continue to rise. Remember securitization, which was first popularized in the 1980s as an instrument for offloading the interest rate risk inherent in 30-year fixed-rate mortgages, whose credit was homogenized and de-risked first by the likes of Ginnie Mae, Fannie Mae, and Freddie Mac, and then by private securitizers. But in the early 2000s, when interest rates were low and stable, securitization began to be used to distribute disparate credit risk in vehicles that were often highly opaque to their direct or indirect owners. The prophecy was self-fulfilling, as easier credit terms helped inflate the value of the homes, the collateral. New borrowers and lenders alike accepted increasing levels of risk through leverage, realizing only too late their outsized exposure to small changes in value. As each then subsequently sought to exit, the cycle was reversed and intensified again. Now, I am no meteorologist, but I know that counterclockwise winds are associated with the most powerful storms, and that is exactly what we experienced in 2008. So having looked at the forces that caused what, if we were living in an earlier era, we would have called the panic of 2008, what did we learn during the financial crisis and its aftermath? And what does that tell us about what's ahead? Among other things, we learned that the most vulnerable financial institutions are those which are most dependent on the continuation of past trends. Trends that, until they're upset by a total market about-face, are taken as given. Think for a moment about the standalone investment banks, Bear Stearns, Lehman Brothers, Merrill Lynch, and how their balance sheets depended on a vibrant and deep capital market to provide daily funding either through what we call repurchase agreements or commercial paper, or a ready channel for liquidating positions in tradable assets. It's illiquidity that can destroy the oldest and most established of institutions. And in the case of Bear, Lehman, and Merrill, it did. These venerable investment banks had relied for scores of years on a funding model that, when market confidence and liquidity disappeared overnight, turned out to be fatally flawed. Now, as for commercial and consumer banks, think of what happened to highly regarded long-term players like Wachovia and Washington Mutual, both names well known here in California. They weren't capital market dependent. Rather, they funded themselves largely through what has long been considered the most reliable source of funding, bank deposits. Now, it may have taken the 24/7 news cycle and social media to create enough uncertainty around those banks that the downside of deposits, the ability for people to withdraw them in real time, would finally materialize. But that's just what happened, and Wachovia and Washington Mutual disappeared. Now, the best solution to assure liquidity is probably balance among multiple sources, something that at Capital One we luckily achieved just a few quarters ahead of the crisis. As I noted earlier, Capital One was created as a capital market-funded consumer lender. But recognizing that model's vulnerability, the company acquired two large commercial banks in 2005 and 2006 to diversify its liabilities to include a more than equal level of deposits, just in the nick of time. Now, what the crisis also teaches us, or hopefully reinforces, is that margins need to be calibrated to the level of risk, not whatever it takes to win a particular loan deal or to show a higher nominal yield than competing investment funds. Mortgage loans in particular were being made on the presumption that collateral value, housing prices, would always rise. So narrowing margins and increased structuring were a threat to profitability, but not to solvency. In the case of mortgages, this was obviously proven wrong. On the other hand, revolving balances on credit cards, an asset class with no collateral, relied only on the ability and willingness of borrowers to repay. As such, they tended to carry much higher margins, enough, as it turned out, to cover the unprecedented losses in that market. Indeed, while credit card defaults rose appreciably, even as unemployment spiked, Capital One's credit card business remained profitable, even in the depths of the Great Recession. In fact, the vast majority of credit card holders remained current on their payments, even as many became delinquent on their mortgage loans. That may be surprising. It certainly was to us at first. But as it became clear how many homeowners no longer had any equity to protect, their choice to pay their credit cards and walk away from their mortgages made perfect sense. Now, what we also learned out of this recession was that our parents and grandparents, those who lived through the Great Depression, were right all along when they told us to put something away for a rainy day. Among the shareholders and managers of most financial institutions, that means don't let your capital levels get too low for the risks that you're carrying. because in banking, about a decade ago, we had really high, cyclically high returns on equity that people started to treat as normal. The only way to achieve those returns on a sustained basis was to take risk that was disproportionate to the required capital. How? By carrying exposures off the balance sheet, or simply by assuming that one was safe doing what everyone else was doing, as long as the banking supervisors don't stop us. So, if those are some of the lessons we learned in the crisis, assure that you have liquidity, price rationally, and carry enough capital for a rainy day, it's pretty clear what we need to look at going forward. First, banks and other financial institutions cannot be allowed to operate with weak balance sheets in terms of both liquidity and capital. Now, you may find it surprising to hear from a recently retired bank CFO, and I could show you a few scars, but we actually need to embrace dynamic stress testing. The process is not without its flaws, but next to the Fed's quick action to restore liquidity to the markets and force down interest rates in the immediate wake of the 2008 crisis, I'd say the most impactful policy response was to mandate stress tests for banks, while at the same time providing a temporary capital safety net for those who needed it, and plenty of incentives for the rest of us to quickly raise incremental private capital rather than to prolong the government's ownership of our stock. Failure to follow the Fed's example here is perhaps the most important reason why Japan is in the 25th year of its lost decade, and why I believe the Eurozone banking system remains at risk today. Another thing to remember is that while innovation and competitiveness are critical, they should not come at the expense of taking inappropriate risk. One of my former teachers, Paul Volcker, has famously said that the only worthwhile financial innovation of the last 30 years is the ATM machine. And I'd add that much remains to be done to provide customers with the kind of digital and mobile technology they increasingly demand. Still, while I appreciate Mr. Volcker's sentiment, I'd consider his position too extreme and would be careful not to overcorrect when it comes to financial instruments and market structures. For example, at a time when many consumers have been able to sustain themselves by refinancing older mortgage loans, and we're increasingly likely to face a more unpredictable interest rate environment going forward, I think consumers are exceedingly well served by the availability of 30-year fixed-rate prepayable mortgage loans. This would not be possible if all mortgages had to be deposit funded, or if we didn't have market mechanisms to separate out and redistribute financial product risks. Now, I haven't forgotten that reckless use of these mechanisms contributed mightily to the crisis, but I also know that there are better ways to avoid too much of a good thing than getting rid of it altogether. In fact, I was pleased to read last week that European central banks, discouraged at the lack of lending going on in their economies to support financial growth, are trying to revive their securitization markets, even though they're trying to avoid exotic and complex structures. Finally, and at the risk of sounding unappreciative for all the good which official Washington did to mitigate the worst effects of the financial crisis, I think it's important that we balance efforts to prevent the next crisis with those that are designed to recover from the one we've just been through. Over-regulation, not to mention the uncertain prospects as to how it will be implemented, is a natural response to what in hindsight is reasonably perceived as under-regulation. But it's still not an optimal response. This is especially true when the cumulative effects of an avalanche of sometimes disjointed rulemaking discourages financial institutions from fulfilling their role of responsible lending and risk-taking at a time our economy continues to suffer from inadequate growth. To be clear, I appreciate smart and well-tailored regulation. Consumers of financial products need to know what they're getting, and banks, investment funds, and others like them need to deliver what they promise. Taxpayers and markets alike need to know that no institution is too big, too complex, or too interconnected to fail. But we also need to learn from history that market forces which produce innovation, efficiency, and growth need to be nurtured as well as monitored for excesses. As a society, we need to incentivize risk-taking as well as to require financial discipline and effective risk management. So that's the challenge we collectively face today. Armed with the lessons of history, both the last 3 crises and the ones of the previous couple of 100 years, and the desire to advance, I am confident that financial institutions, together with policymakers, regulators, supervisors, shareholders, consumers, all of us, can once again rise to the challenge. With that, I'd like to thank you all again for the privilege of speaking to you this evening, and I look forward to answering any questions you may have. Thank you. Okay, I'm going to repeat your questions so that we keep that. Oh, good. We keep that on record. Yes, sir.
I have a question regarding
Yes.
the current Ukraine crisis that
Yes.
is ongoing at the moment. This has been it's really messy, and the U.S. has threatened financial sanctions, or it's already using financial sanctions against Russia. Do you see the Ukraine crisis as big enough to affect U.S. financial markets going forward?
So the question is, does the current crisis in the Ukraine, where the U.S. is threatening more financial sanctions, do I consider it big enough to upset the financial markets? In short, the crisis itself in the Ukraine is not big enough to create a big financial crisis. It's unfortunate to look at the world this way, but the Ukraine is a relatively small economy. It is not all that interconnected with other markets. But then again, Ukraine as a political crisis, should it create tensions between the U.S. and Russia, should it threaten economic growth broader in Europe, does it have the potential to become a big crisis? Yes, except I'll give you one rule of thumb. Crises are not usually triggered by things you're reading about on the front page. Crises are usually triggered by things that show up in the second section of the paper at the bottom, right, where you would barely see them, because those are the crises waiting to happen that people ignore while they're all rushing to do something else. So I assure you, if you go back to 2007, you would start to see stories in the newspaper that say, I wonder if housing prices can continue to go up like this, right? But it wasn't a front page story. So people ignored it. So again, the rule in markets is, if everybody knows about it, it's probably not going to be a problem, okay? It's the things that people are ignoring, that fester, that people ignore, that once they bubble to the surface, everybody runs for the exit at the same time. That's a crisis. Yes, ma'am.
Speaking of things that are happening in the background, what's your opinion about the very high-speed trading that's happening, the computer trading in the securities market, and does it have the potential to actually take over the volume and actually cause exit of investors on in private investment?
Sure, a very topical question here about high-speed trading that we're hearing a lot about, recent publication of a book, and does that have the potential to take over? You know, it is interesting. When I think back, I grew up in Chicago. My family were very active traders on the Chicago Board of Trade, where commodity futures were traded. And in the good old days, people used to go onto the trading floor and trade with each other. And they would jump up and down and they would yell, and it was like an auction. But it was like an auction that we learned about in economics class, where they talked about shoot the auctioneer. What happens when there's an auction going on and nobody in charge? People are yelling and screaming at each other. And that's how markets used to be. Even at the New York Stock Exchange, where people traded stocks, you literally had a person standing there, okay, collecting buy orders and sell orders and putting them together. Well, over time, encouraged by government, but also by technology, people said, you know what? Those guys standing on the trading floor have too much of a monopoly over the information because they know how many buy orders and sell orders they are, and somehow they're going to take advantage of it. So you know what? We're going to mandate that all of this trading be done electronically to take out the middleman, right? So the whole idea of electronic trading was actually designed to create more transparency, more efficiency, and to give more power to the individual. Well, it was a good idea, but technology evolves. People always are incented to invest to try and make a quick buck. So what have they done? They've said, well, wait a second. If all of these orders are going to be matched, if I can get mine in faster than anybody else, I will have an advantage. And it is true that those people who have invested in the high-speed fiber technology that I know nothing about, but that gets the information to the exchange really quickly, they're going to get a better execution, if you will, than you or I might. Do I think that's a problem? No. I think it's a problem when it comes to market resiliency, because what we've seen is when one of those computers goes down, we have to stop trading. And there's been a lot more stopping of trading over the last year than there used to be. That's a problem. But I somehow believe that technology people are going to figure out how that works. But is it inherently unfair, and is it going to keep us from doing what we need to do? I mean, when I put money into my grandson's education fund, if I'm buying a share of, I don't know, AT&T, I mean, might I be paying 1 penny more than somebody who's trading $100 million worth of stock at that moment and can get that order in ahead of mine? Maybe I am. But to pay a penny more today, I'm still probably getting a more efficient transaction than I used to when there was a guy standing there matching the pieces of paper. And I'm going to hold on to that investment for 20 years. And when I go to sell, is somebody going to be able to do a penny better than me on the execution? Maybe. So I think this is one of these situations where if there's a big winner out there, everybody starts wondering who the loser is, and it must be us little guys. To a large extent, the big winners are sometimes big losers because they think they're going to be able to get ahead of the next guy, and they're not. So I think it's something to be watched. I think we don't want to become overly dependent on the technology. On my list of worries, frankly, it's pretty low.
How would you incentivize risk-taking, and how is the Eurozone at risk? 2 questions.
Okay, so 2 questions based on what I had said. First of all, how is the Eurozone at risk, and how would I incentivize risk-taking? May I take them in opposite order? Okay, so why is the Eurozone still at risk? The Eurozone is still at risk because we don't really know how strong the banks are, because no one has done a thorough scrubbing. Now, they're in the process of doing it right now, but something interesting went on in the Eurozone that is a lot different than went on here. So what happened in the Eurozone is that the Euro banks, the big ones, and of course they're really big there because they tend to be government sponsored, and there are 2 or 3 big banks per country. If you look back to the early part of this century, they were making investments in 2 things. One, subprime mortgage-backed securities from the United States. Bad choice. The second thing they were investing in was government bonds issued by European governments. So when the crisis of 2008 hit, clearly banks had made a lot of bad investments in US mortgages. What some people don't realize is that as much money as US banks lost, and it was a tremendous amount of money, I mean, hundreds of billions of dollars, the European banks lost even more because they were hungry for the yield and they had no idea what they were investing in. But as a result, those banks were weaker, and so they turned around and said, well, what can we invest in that is really secure, that will help us get out of our problem? We know, we'll invest in government bonds issued by Greece and by Spain and by Italy and by Portugal, and don't worry about it because there's no currency risk because they all have euros, and after all, they're governments, and governments never default, okay? They forgot about Argentina. Okay, they forgot what happens there. So you have this situation where the banks in Europe were so weak that the government, rather than doing what they did here, which was to force them to come clean and clean it up, basically covered it over. And why did they do that? Because if the banks over there said, we have to sell all of our Greek bonds and Irish bonds and so forth and so on, the banks would have created a government crisis. So the banks in Europe have not been allowed or forced to come clean. And as a result, when you don't know what's going on in a bank, and remember, a bank is like any other company, except that all of its assets and liabilities are pieces of paper, which may or may not be worth anything. Okay? It's like going to a poker game where everybody's just signed a little piece of paper. You give them the chips and you have no idea whether they actually have money. And what happens? When you look around the table and you see somebody who you're not quite sure is good for it, you stop doing business with them. So the European banks are continuing to go on their merry way, and we don't know whether there's problems there or not. They're not willing to make a lot of new loans and take a lot more risk, and that's keeping the economy there from revving up. So I think they haven't quite faced their day of reckoning yet. And now, what makes me a little bit worried is that because of the lack of economic growth in Europe, they're probably facing the specter of deflation, prices going down. Because of that, people start buying more government bonds, right? Which is why they all went and bought Greek bonds last week, because they got 5% on Greek bonds at a time when interest rates should probably be 0, because there's no inflation. So I just think they haven't gotten off the treadmill yet. And as a result, if something goes on in the Ukraine, it's more likely to affect Europe than it is us. And in the long haul, it could come and beat us. Okay, how would I incentivize risk-taking? There's only one way I know to incentivize risk-taking, which is to allow people to reap the rewards and to pay the consequences of taking risks. And I think we are in a world right now where, because when we look back, we see that a lot of people were hurt badly, not just in terms of financial assets and liabilities, but in terms of losing jobs and homes and everything else, and somebody must have gotten rich and took it away from them, that wherever you look, there is a desire to, in effect, reduce risk-taking, right? So what do? We say, let's not let people earn bonuses for returns on the risks that they've taken. Well, you know what happens when you don't let financial institutions pay people bonuses? They pay them salaries, right? Isn't it better to say, no, you don't earn any money unless unless you make it, okay? Now, again, there comes a point at which there might be too much risk taking. That's what happened before. But I think we are, in effect, telling people, and I see it all the time in big banks, where it's, okay, there's a risk taker, then there's somebody who has to look over the shoulder of the risk taker, then there's an auditor who looks over the shoulder, and at the end of the day, people are afraid to take risk. And I think we have overdone it. Because what makes our system tick is the willingness to take risk. I mean, we think it's great when people create tech startups and become billionaires overnight. Okay, they took big risks, and frankly, there wasn't much downside. But somehow when it comes to finance, where everything is just a little bit mysterious and always seemed a little bit rigged against the little guy, it's hard to get up there and say, let people take risks and earn something in return. And again, I think it's because we let it go on too long, and too many people were hurt in the process. And I think we should not be worried about getting even. I think we should be worried about getting ahead. Yes?
I was just going to say, I wonder if that's what was worried, for instance, the subprime loans that you were talking about, you were applying. My impression was that at least a big chunk of them were actually AAA rated subprime loans. So, in other words, somebody looking over the shoulder who should be assessing risk was like, oh, these are great. So, how do you square that?
Right. So the question here is, but what about those subprime mortgages that were rated AAA, and who was looking at those risks? Again, that was a period of time where the risk was not being well managed, right? That was up until 2008. And let's remember that subprime mortgages was originally considered a virtuous thing, right? What did it mean? It meant that the prospect of owning a home was going to be made available to people who didn't have great credit. Now, what was the whole idea behind that? Did we ever believe that those people could afford those mortgages? Well, not exactly. But as long as the price of the house kept going up, it's okay if the person couldn't afford the loan, because they could sell the house when they could no longer afford to pay the mortgage. Right? So that whole system was based on this notion that housing prices would continually go up. And did anyone ever think a subprime mortgage was a AAA investment? No. They never did. What they did do, however, was to say, okay, if I take a subprime mortgage here and a subprime mortgage there and a subprime mortgage here, and I put them all into one big pool, and I get some really smart people into a room, and I take out my knife and I go, shh. Okay, I'm going to put the risk over here, and I'm going to take some of this risk, and I'm going to put it over here. And this part that's left, this is good as gold. Okay? And the fact of the matter is, I think most of the people who did that believed it. Okay? But it turned out not to be exactly right. Okay? And so, although the market, by the way, went way down, and now it's started to come back, and people who bought some of that stuff are doing pretty well. But at the end of the day, there has to be a balance between risk on one hand, right? And because if you get rid of risk, if people can't take a risk on you, I mean, think about the credit card market, okay? If you don't give somebody that first $1,000 line of credit, how do you know whether they're going to pay it back or not, right? But I can tell you from experience, if you have 5 people who've never had a credit card before, and you give a $1,000 line to each of them, chances are at least 3 of them are going to turn out to be great credits. They're going to use the money to build something or invest in something or to, sustain themselves while they're working on some great experiment. And then the other 2 probably aren't going to make it, okay?
So what you have to do is you have to say, well, look, I will charge a high enough rate, okay, to cover that risk, and effectively, the good people, the people who actually pay it back, end up subsidizing the people who don't. But once they prove themselves, they're going to get a much lower rate, they're going to get more credit, and so forth and so on. So we all depend on people taking a risk on us. If we want people to take a risk on us, we have to let them take risk. Yes, sir.
Given the unknown in the banks of the Eurozone that you mentioned, what are the prospects of, the long-term prospects of the euro being the common currency in the future, given 17 different countries, presumably 17 different balance sheets, and on and on?
So the question is, with the uncertainty of the health of the European banks, what is the prospects for the euro itself continuing as the common currency? You know, the euro as the common currency was really more of an act of faith than an act of logic. It was created far before the conditions were ripe, because as most economists would tell you, you can't have a currency union unless all of the participants are more or less at the same level of economic development, and as long as they are willing to sort of coordinate their policies. If you want to know what a good currency union looks like, go back to 1792. And the economies of the different states being put together into one common currency. Actually, that was one of the first crises that you read about in The Economist, because they, again, in order to make sure that the currency union worked, ultimately the government had to protect everybody. So the euro was created well before, and they still don't have a situation where you've got this strong economy like Germany with a lot of growth and exports and savings. And then on the other hand, you have Greece, you know, which had 10% deficits and so forth and so on. Very hard to make that work. However, there's such an interlocking of those economies now, and so many of their assets and liabilities are denominated in the single currency that it's very hard for them to imagine kind of, you know, breaking apart. So frankly, I have a feeling that the Europeans will in fact keep it together. It will be expensive, and they will need to figure out how the richer members of that union are going to interact with the weaker ones. Because the folks in Germany are not too happy about subsidizing what they perceive to be the lackadaisical ways of the Mediterranean countries. Well, you know what? You know, sometimes you have relatives like that. You know, but it's family. And at the end of the day, they're going to stay together.
Talking about the currencies, how do you see the future of Bitcoin going forward?
Yeah.
It's very controversial
Yeah.
to be created this, but the Federal
Yeah.
Reserve
Yeah.
won't come.
So what's the future of the Bitcoin? That is something about which I am totally ignorant. It makes no sense to me at all. You know, I know some people say it's a great technology. You know, why should you have to pay 2%, or why should merchants have to pay 2% of every transaction to Visa and MasterCard in order to connect all the banks and everything else? Well, I think what we saw with Bitcoin in a very short period of time was what happens, right? When people sort of forget about reality and get excited by the moment. Let's just remember that there are two purposes for money. I mean, you'll learn this in Econ 101, right? Money is it's a means of exchange. It's a, you know, so we don't need to carry around rocks and sticks like they used to do, you know, 3,000 or 4,000 years ago. You know, it's cheaper to carry a few bills in your wallet, okay? And, you know, if I sell something, I get the dollar, and then I want to go buy something. I mean, instead of bartering, it's really convenient to have currency around as a means of exchange. Well, I don't know. But the other purpose for money is as a storehouse of value, which is I earn my money, I'm not ready to spend it, I might need it later on, when I'm old and feeble. So what am I going to do? I'm going to hold on to I'm going to take my money and I'm going to put it in the bank. I think with Bitcoin, people weren't really clear about which of those two things it actually was. I have a feeling it might not be a bad means of exchange. I don't think it's a very good storehouse of value, because something that goes from $500 one day to $1,000 the next day to $600 the next, it's not a good storehouse of value. Whether it's a good means of exchange, will depend on, how good the technology is and whether it gets, picked up by others. But let me take another question here.
First of all, I want to thank you for coming to UCLA and delivering a really excellent, comprehensive historical talk. I want to go back to Washington and ask you about Fannie and Freddie.
Mm-hmm.
They, for a long time, were perceived to be private, but they really had an implicit guarantee of government. Since the crisis, of course, they've been taken over. Ginny already, of course, is still a subsidiary. Do you think it would be wise to privatize Fannie and Freddie, which is being talked about? We all know that the government does such a wonderful job running big operations, like railroads, and we'll see what happens with healthcare. I'm personally very skeptical about it. How about Fannie and Freddie? The pressure seems to have come down a bit. What do you think would be a good roadmap for them?
So the question is about the future of Fannie Mae and Freddie Mac in particular. And let me just say I agree totally with your historical view, which is that Fannie and Freddie were in fact privatized. Fannie Mae was privatized in 1968, Freddie Mac a couple of years later, meaning that all of the stock was owned by private shareholders, or it was a publicly traded company. And yet the debt that they issued in order to fund their operations and the mortgage-backed securities that they issued were treated by the market as having a government guarantee. And I think we have all learned that, and this is sort of Washington talk here, okay? If you socialize the risks and privatize the profits, somewhere along the line, it's not going to work out well for the people who have the risks, meaning all of us. And so I think to go back to the old Fannie and Freddie makes no sense at all. Fannie and Freddie today are in effect owned by the government. Believe it or not, and I don't have a horse in this particular race, but as taxpayers, we have now actually earned more from Fannie and Freddie than it cost us. And we will continue to earn from Fannie and Freddie, and that's a good thing, okay? The public took a risk by taking them back, and the public should earn those returns. There are some private folks who would like to get their hands on those returns. I don't believe in that. But I think going forward, yes, we need to find a way to make sure that our mortgage system is not dependent on the government. Frankly, what Fannie and Freddie and Ginnie Mae as well, what they have given us is a technology that, frankly, the market can make work without the government. There are ways to securitize mortgages and to make mortgage loans at very attractive rates to people without having the government involved at all. And so I think if we were to make sure that there was no government sponsorship of the mortgage business, the government would then limit itself to those areas where the markets wouldn't serve, the low and moderate income housing, where they'd have to find a way to, but put it on the budget, right? Don't try and make it happen without actually spending the money, right? Ginnie Mae, FHA, VA, those sorts of things. I think that would be the right way to do it. I think the big question in Washington right now, and there is a bill that's been introduced in the Senate Housing Committee. By the way, for those of you who have totally given up on bipartisanship in Washington, it's probably the best example of bipartisanship we've seen. It is It was Senator Warner of Virginia and Senator Corker of Tennessee who put it together, and Senator Johnson of North Dakota, who is South Dakota, who's a Democrat, and Senator Crapo of Idaho, who's a Republican, have put this together. And what they've said is the government will stand behind mortgages in an insurance context, but only if there's 10% of the risk put up front by the private sector. The real question is, if we said the government wipes its hands of it, it goes away. If things really got bad someday, wouldn't the government have to say, okay, we can't afford to let all of these guys go belly up, so we'll support them? Is it better to establish up front how that insurance is going to work and just really try and set it up so that it never gets used? I think that's the question. I think they're getting closer to it. But going forward, the last thing we want to do is have Fannie and Freddie the way they used to look. That obviously doesn't work. Yes, sir.
In your view, if the U.S. government wants to now back in crisis, does the 30-year mortgage disappear?
No. Again, if the question is if we get rid of Fannie and Freddie, does the 30-year mortgage disappear? No, because again, the 30-year mortgage exists. I don't think it would have been created without them, but it now exists. The market is very accustomed to it. It's a very standardized product. And although the 30-year mortgage could not easily be handled by a local bank because it only has your deposit as far as it knows overnight, so they'd be afraid to make a 30-year loan. But the fact of the matter is the technology of securitization can work without Fannie and Freddie. So this is not about the 30-year mortgage. This is about who owns the technology, who puts out the ultimate risk for the totally catastrophic scenario. But 30-year mortgages can absolutely work as long as we have the technology. And one of the proposals in this bill is to make the technology, in a sense, a public utility, make it available to everybody. So I don't think it's the end of the line for 30-year mortgages at all. Yeah. Yes, ma'am.
You know, you mentioned that a number like 8,000
Yeah.
banks, really there are fewer than 5,000 banks, and it's down precipitously from about 9,000 banks in the 1990s. And that's true of IPOs and companies, and certainly everything in the American economy. We have shrunk our basic business economy, which is why we are in such a bad situation with job situations. So we have invested a great deal in housing, but we're not investing in the creation of jobs or in the creation of companies in a concerted manner as an entity. Would you address that?
Look, so the question is, we have fewer and fewer banks. Is that not indicative of investing less and less in job-creating growth in this country? I don't particularly believe the number of banks is relevant, in the sense that one of the reasons we have fewer banks is that if everybody expects to be able to do deposits from their smartphone, and if everybody expects to be able to do their banking online, that means you have to have a bank who can invest in the technology to give that to you, okay? Slippery Rock Bank, down on Main Street, if they're really, really small, are not going to be able to do that anymore. And being small, okay, maybe what we will really miss about Slippery Rock Bank is that they knew the person in the shop front next to them, and they knew that their business, small as it was pretty good, and they were going to support them, and so forth and so on. So the question is, how do you find a way to make sure that small businesses have a source of finance? And by the way, I don't think the answer is to have small banks next door to them. I think the answer is you can have economies of scale in things like finance and technology, but I think what you need to do is make sure that small businesses have the ability to grow, and one of the ways to do that, and again, it doesn't necessarily need a government program there, but large financial institutions can actually afford to take the risk on a small guy. Like I said, think about the credit card business. We were willing to take risks on millions of people, and we knew that hundreds of thousands of them were going to go bad. We just didn't know which ones. So because we were big and because we were dealing with so many people, I mean, Capital One, as an example, has 70 million customers, okay? Every year, 1 million or 2 of them are going to go bad. We don't know which ones. But if we know that 68 million are going to be good, we can afford to take risks and take some losses on the 2 million. Slippery Rock Bank can't afford to take losses. They're too small. So I don't think, I think we need to make sure that regulations and everything else are not rigged against the small guy. And we certainly see with some of the IPOs these days, people who invest in small technology, can really make it big. But I don't think the way to do it is to keep banks small necessarily. Now, there are other problems with big banks. They're complex. They take a lot of risks they may not understand. And we have to make sure that those are pretty well regulated and let them, if they lose money, then they have to go out of business. So I think we have to recognize that finance is different than a lot of sort of real economic activity. And keeping them small artificially, I don't think is the answer. I know we're getting very close to our time here. Yes, sorry.
Regarding subprime loans and derivatives.
Right.
So if they were two of the culprits of the
Yes.
2008 economic crisis, my understanding, and correct me if I'm wrong, is that regulation hasn't occurred to make either one of them untouchable, and my understanding that they're both still occurring. If that's true, why wouldn't that make us think that
It's going to happen again.
Right.
Okay, so the excellent question, as all of them have been. So the question is, if the problem was sort of the unnatural notion of subprime mortgages and derivatives were the culprits, and they haven't been outlawed, and they're still happening again, why aren't we going to sort of relive this all over again? So, again, there are different kinds of subprime mortgages. So a subprime, how many of you know your credit score? Okay, so if your credit score is over 660, your FICO score, then you're a prime customer. Okay, if your FICO score is less than 660, you're a subprime, customer. So the question is, should somebody with a 650 FICO score be able to qualify for a mortgage? Well, sure. It depends on why their credit score is where they are. If they have an actual job, unfortunately, the subprime mortgages that were made in 2007 were being made to people who didn't have jobs because nobody was checking the paperwork, right? So if someone actually has a job, but they don't have a good track record, but they have enough earnings that they can pay 30 or 35% of their income, and they can afford a mortgage, why would we force them to be renters if they could be homeowners, right? But they'd better really be able to pay it, right? And if they're buying a house in a neighborhood where every other house is selling for $250,000, and somebody says this house is worth $350,000, somebody should say, probably not, okay? So again, if the system works, okay, if people don't say, don't worry about the system. I know that doesn't make sense, but have you seen what's happening in the markets? It's the froth where people weren't doing things the right way. It wasn't that there was something inherently wrong about making a loan to somebody who's not a prime customer. How do you become a prime customer if you can't get a home, if you can't get a job, right? And pay a certain number of months in a row, and voila, a non-prime customer, a subprime customer, becomes a prime customer. You got to start somewhere, right? So there's nothing wrong inherently with making loans to people, right? All you need to do is make sure that people can afford their loans they're taking out, they're reasonable, okay? That you're not mixing a little bit of fairy dust into them and sort of turning them into gold, right? And again, derivatives, okay, someone was asking about what happens to 30-year mortgages. Well, you know what? If I'm a bank and I want to give you a 30-year mortgage, but I don't have 30-year money to give you, I need to be able to somehow manage my risks until I can find somebody who does have 30-year money to make that loan. In the meantime, I'm going to have to use derivatives. So again, it's like looking at tools in your home, right? Tools that can be used in a destructive way are also the tools that you need in order to repair your plumbing and to do other things. So the only question is, how do you make sure that people are using those tools for good purposes and the way they were intended? Okay? You have to have rules, okay? And you have to have people who are checking it. But again, if you simply say just get rid of them, outlaw the tools, we're going to restrain ourselves and we're going to keep opportunities from people who should otherwise have them, right? And I think that is really the key. So with that, I'm going to say thank you. I'll stick around a little bit, but thank you very much.